All right, let's unpack this. We are diving into the Q3 2025 earnings conference call for DigitalOcean Holdings, Inc. That's DOCN. And this was a really pivotal moment that happened pre-market on November 5th.
A really pivotal deep dive, yeah. Because this quarter, it just fundamentally shifted the whole story for DigitalOcean. The market reaction was, it was sharp, strongly positive.
And why was that?
Because the execution signals were just undeniable. The whole focus, it's not just on small developers anymore. It's now firmly centered on their big transition.
The move to higher value workloads.
Exactly. Higher value, AI-centric enterprise workloads. That's the new game.
So here's where it gets really interesting. Let's hit the immediate scoreboard first. The headline was a clean, just a decisive beat on the key operational numbers. Non-GAAP earnings per share came in at 54 cents.
Which easily beat consensus by 5 cents.
And that operational number, that 54 cents, that's what you really need to be paying attention to.
Right, because if you just glanced at the press release, you might have seen a totally different number.
You'd see the GAAP EPS reported at $1.51.
$1.51. So help us understand the noise there. If that number sounds amazing, why did the market just ignore it?
Because that $1.51 figure was, it was heavily inflated by two major one-time accounting events. They booked a large gain from extinguishing some debt, and they also had a huge tax benefit.
A valuation allowance release, right?
Exactly. These are, they're financial engineering moves. They're not signs of core operational strength. That 54-cent non-GAAP figure is the true measure of their quarter-to-quarter performance, and that's why the beat there was so well received.
Absolutely. So moving to the top line, revenue clocked in at $230 million.
Beating consensus by about $3 to $4 million.
And crucially, that marks 16% year-over-year growth. 16%.
Which is the highest growth rate DigitalOcean has achieved in 2 full years.
Yeah, since Q3 of 2023.
60% is solid, but what was it that signaled that, that true momentum?
It was all about the quality of the new business. You see it captured in their annual recurring revenue, or ARR.
Okay.
ARR hit $919 million, which is great. But the massive signal, the real tell, was the record incremental organic ARR.
How much was that?
They added $44 million in new repeatable revenue in 1 quarter.
Wow.
That is the highest incremental ARR in the company's entire history. That kind of acceleration signals a fundamental demand strength that the market is clearly validating.
That record ARR, it signals a fundamental shift. So let's dive deeper into where that quality is coming from, because it sounds like they're not just chasing volume anymore, they're chasing bigger, stickier customers.
Precisely. We are seeing major traction with these high-value customers. Revenue from customers spending over $100,000 in ARR jumped 41% year over year.
41%.
They now represent over a quarter, 26% of total revenue.
And if you look at the very top tier, it's even more dramatic.
Yeah, the customer spending over $1 million in ARR grew 72%.
72% year over year.
And collectively, this top cohort now accounts for over $100 million in total ARR.
So this is the key insight, right? This growth, it sort of removes that historical worry that scaling businesses would eventually just outgrow DigitalOcean.
Right, that they'd automatically jump ship to a massive hyperscaler.
Yeah. But DOCN is proving they can handle that serious growth now.
And the thing fueling that is the AI engine. AI revenue has more than doubled year over year for the 5th consecutive quarter.
5th quarter in a row.
This AI native segment is the undeniable key accelerant here. It's shifting the entire business mix towards specialized high-margin workloads.
Okay, so that's the growth side. But they also spent a lot of time shoring up the financial foundation. They aggressively cleaned up their balance sheet and way ahead of schedule.
Yeah, think of it like a massive prepayment on a credit card, but you get a bargain while you're doing it. They repurchased $1.19 billion with a B face value of their 2026 convertible notes.
And they did it at a $56 million discount.
$56 million. That's essentially free money for operations, and it materially de-risks the whole balance sheet well ahead of that 2026 maturity date.
So if we connect this to the bigger picture, let's talk cash flow. Adjusted free cash flow was, it was a massive $85 million.
Which translates to a 37% margin.
Right, and that's up significantly from just 13% a year ago.
The jump in cash generation is phenomenal. But they also introduced a new metric, unlevered adjusted FCF. What's the purpose of introducing, more jargon?
It's purely for clarity right after that debt cleanup. Because they financed part of that repurchase by drawing on a new term loan, they now have a moderate interest expense where they didn't have one before.
Okay, got it.
So unlevered FCF gives you that clear view of cash generation before you factor in those new financing costs. It helps the market see the powerful operational cash engine without the noise of the new debt structure.
Also worth noting on the customer quality side, net dollar retention stabilized at 99%, which is up 2 full percentage points from 97% a year ago.
Yeah, okay, 99% is stability, but given the massive growth in those million-dollar-plus customers you just detailed, why isn't net dollar retention higher? Doesn't that sort of imply they are still seeing a lot of churn at the lower or middle tier?
That's a great challenge. And management would tell you that 99% shows stabilization despite the continued churn of those smaller, highly price-sensitive developers.
The ones who are historically over-indexed in their customer base?
Exactly. The fact that the massive gains from the high-value customers are just offsetting the continued friction at the low end, it shows the shift toward quality is working, even if it hasn't resulted in a headline number over 100% yet.
So to keep these high-value customers happy and scale them further, they need a completely different sales pitch. Is that what led the CEO to pivot the entire story around this new agentic cloud concept?
That is the perfect transition. The CEO was clearly really enthusiastic about the unified agentic cloud. He was emphasizing that DigitalOcean is emerging as a preferred destination for AI and digital native enterprises.
And this term agentic, what are we talking about here?
It means the architecture is specifically designed for autonomous AI systems, for the new generation of specialized AI agents, so they can run and scale easily.
And what are the components that make it agentic? What's in the box?
They highlighted the specific product stack tailored for this, their focused GPU droplets, the Gradient AI platform, and new features designed for scaling enterprises.
Like
Things like network file storage, NFS, for high-throughput processing, and then the enterprise-grade cold storage, passes core storage, designed for massive data retention.
And they back this up with some great examples. They mentioned FAL.ai, the generative media platform, using those specialized GPU droplets for complex AI inference workloads.
And we also heard about Newsbreak.
Right, Newsbreak, leveraging the unified stack for their complex recommender systems and large-scale NLP models. It makes the whole concept tangible.
And what's fascinating here, and really the core of the market excitement, is the forward guidance. Full year 2025 revenue guidance was raised, which is always nice.
Always good.
But the massive confidence signal was the acceleration of their multi-year target. They now expect to achieve their long-held 18 to 20% revenue growth target a full year early.
For 2027, they're pulling it into 2026.
Yes, a full year early.
Pulling forward a major multi-year financial goal by 12 months that's an incredible statement of confidence. What is that conviction based on?
Well, management stated this confidence is backed by signing multiple new 8-figure committed contracts right after the quarter closed. They see the future revenue stream with enough visibility to make that aggressive commitment.
But, okay, there was one divergence point that caught some attention. The Q4 non-GAAP EPS guidance came in below consensus. The midpoint was around 38 cents versus a 46-cent consensus. Why the sudden dip?
That lower EPS guide is explicitly the price of acceleration. Management is prioritizing growth and long-term capacity over any near-term margin maximization. They openly acknowledged a severe capacity crunch.
A capacity crunch.
Yeah, demand for their agentic cloud, and especially for GPUs, is just outpacing their current data center footprint.
So if they've got these new 8-figure contracts, they have to invest heavily right now to be able to service them.
Exactly. They are aggressively ramping up capacity. They're securing about 30 megawatts of incremental data center space, ordering more GPUs. Management warned that this heavy spending will result in higher cost of goods sold and operating expenses into early 2026.
And that's going to temporarily pressure gross margins.
Right. So the lowered Q4 EPS guide reflects this disciplined choice. They're betting that the resulting revenue growth in 2026, fueled by those high-quality contracts, will eventually swallow this cost and validate pulling that growth target forward.
So the inflection point for the market is simple. Do these heavy near-term capital expenditures successfully support the large contracts and translate into durable revenue growth?
And does that validate pulling that 18 to 20% growth target forward? That is the central question through 2026.
Which brings us to our final segment.
And we have to give the required disclosure. This is not financial advice. We are not recommending you buy or sell any security.
We are simply offering an outrageous but plausible trade idea based purely on the information and the conviction signals we just covered.
Okay, so if the bullish narrative holds,
If DigitalOcean successfully executes on its niche AI strategy and continues to accelerate faster than the broader cloud market,
then you bid big on that conviction.
a recent analyst upgrade cited a $60 price target following the call, so that gives us a clear anchor for our bet.
The bet would be a highly leveraged long position. You're betting on that significant re-rating through 2026.
So we're talking about going long DOCN via long-dated call options.
Exactly. This captures the powerful upside if the stock re-rates sharply, but it requires far less capital commitment than just buying shares outright. It's a bet on leverage.
And to mitigate the macro risk, because tech stocks can be volatile.
You'd simultaneously short a small position in a broad cloud computing ETF, something like the Global X Cloud Computing ETF, CLOU.
So this makes the trade a pure play on DigitalOcean's unique ability to execute and outpace its peers, which it has demonstrated.
Right. If DigitalOcean hits that aggressive growth target a year early, this leveraged pair trade is designed to capture some really outsized returns.
So to recap, Q3 2025 was a defining moment for DigitalOcean.
It was a clean beat. It was driven by record incremental ARR and high-value customer acquisition, reinforcing the company's whole AI-native vision.
And the ultimate takeaway is that massive confidence signal.
Pulling forward the 18 to 20% growth target to 2026, despite the short-term margin hit from those necessary capacity investments.
So what does this all mean for you? Given management's focus on simplicity and predictable pricing, the final provocative thought for you to chew on is this. How successful will DigitalOcean be in stealing core cloud migration workloads from the massive hyperscalers, leveraging their reputation for simplicity while simultaneously scaling its highly competitive AI and GPU infrastructure fast enough to meet the demand they have so clearly created? That dual challenge will define the coming year. Thanks for diving in with us.